So the question comes, why Somerset Capital in emerging markets and why dividend growth in emerging markets? And my belief is really this, that you have to find a specialist if you're going to navigate the choppy waters of the emerging market asset class. You have to find a company where there are a band of highly trained, focused individuals who are incentivized to work together, as in our partnership structure, who have the experience of these markets and who take the type of conservative long-term approach that we think is most appropriate in this asset class. Ultimately, at Somerset Capital, we spend a lot of time trying to keep our business small, actually, rather than trying to overgrow it. We cap all our products, and that's very unique in this industry where people look for growth. For us, we want to focus on performance, and the long-term stability of our business comes from delivering that performance for our clients. The follow-on question, why dividend growth investing? Well, I've spoken about this already in the past, and I would focus on one key point. The companies that are going to succeed over the coming decades in emerging markets, in fact, we think anywhere in the world, are going to be those that can sustain their business model, can manage their cash properly, and can grow without recourse to capital markets. And they are going to be the ones that can pay their dividends and grow their dividends over time. Finally, to summarize everything, we believe in the compounding effect of dividends. We're not trying to build just a high-yield fund here in emerging markets. We're trying to give you, the client, access to what we think is one of the most exciting asset classes in the world at this time. And we're trying to do it in a way that we think can reduce volatility, is conservative, and ultimately gives you those fantastic long-term returns that we want to deliver to our investors. So when I look at the philosophy of emerging market investing, I concentrate on a couple of key things. The first is that we're active managers. I think in emerging markets, much of the conversation has to be about risk above all things. And to do that, you have to actively manage your portfolio. The second is we're very long-term. We take a 5-year view in the dividend growth strategy. If you look at emerging markets over time, always the long-term view pays out. And finally, we're very conservative. That probably chimes with our active and long-term approach. But many of our clients are children's hospitals, they're foundations, they're endowments, they're individuals who want to preserve their capital. And we take that very seriously. We think that if you can reduce the risk on the downside, in the growing markets, in the emerging market asset class, you can get really good returns for your clients. And that is at the core of our philosophy. One of the reasons why we like working with Redwood in Canada is because they introduce us to a client base who is already, through their domestic Canadian equities, very exposed to the global emerging market commodity play, for one thing. You know, if China goes up and looks like it's going to increase its GDP, Canada will benefit, and vice versa. So one of the strengths of dividend investing is it pushes you out of often the more highly valued popular markets into those that are more contrarian, like South Africa, for example, or Chile. So in Canada, it's very important when you're looking at your overall equity exposure, not to invest in an emerging market fund that may just duplicate that, i.e. one that may track the index, which is very heavily weighted towards energy and materials, but instead look for a fund, possibly like the approach that we're taking, but that gives you true diversification into emerging markets and doesn't just double up what you're already getting with your Canadian domestic exposure.